There is a pattern in history that has ended every global reserve currency without exception, not through invasion, not through catastrophe, but through mathematics, a sequence that unfolds slowly, predictably, and then all at once. Nations at the center of the system always believe they are different, stronger, smarter, permanent. They never are. From Portugal to the Netherlands, from Britain to the United States, the same structure repeats, the same pressures accumulate, and the same collapse follows. This is not a forecast. This phase has already begun. The only question left is whether we recognize the pattern in time, or whether we repeat the final stage blindly, as every empire before us has done. To understand why every reserve currency eventually collapses, you first need to understand what a reserve currency actually is. It is not simply a strong national currency, and it is not defined by economic size alone. A reserve currency is the currency that other nations hold inside their central bank reserves. It is the currency used to price global commodities, to settle international trade, and to store value at the sovereign level. When a currency reaches this status, global commerce becomes structurally dependent on it. Oil is priced in it, raw materials are priced in it, international loans are denominated in it, trade imbalances are settled through it. Central banks accumulate it not by choice, but by necessity. This creates a system where global demand for that currency is constant and non-optional. Countries must obtain it to function inside the global economy. This status generates what economists call exorbitant privilege. The reserve currency nation can purchase real goods by exporting paper or digital claims. Other countries must produce tangible output to earn that currency, while the issuer can create it at will. The reserve currency nation can run persistent trade deficits because the world needs its currency more than it needs its goods. It can borrow at lower interest rates because demand for its government bonds is structural, not discretionary. This is why reserve currency status is the ultimate economic weapon. It allows a nation to live beyond its productive capacity for decades. It allows consumption to exceed production without immediate consequence. It allows debt to grow without triggering the same penalties other nations face. But this privilege is not free. It carries an internal contradiction that eventually destroys the system. Every reserve currency begins its rise the same way, not through finance, but through power. The first stage is military dominance combined with control over global trade routes. It is not enough to have a strong army. The reserve currency issuer must control the pathways through which global commerce flows. Sea lanes, choke points, strategic corridors. Trade must be impossible without passing through its sphere of influence. Portugal achieved this in the 15th century by mastering oceanic navigation and militarizing trade routes to Asia. The Dutch repeated it by turning a trading company into a global military force that controlled shipping lanes. Britain perfected it through total naval dominance in the 19th century. The United States inherited it after the Second World War by establishing military presence around every critical trade choke point on Earth. This control forces merchants, nations, and financial systems to use the currency of the power that dominates trade, not because it is trusted, not because it is morally superior, but because it is unavoidable. The currency becomes global, not by agreement, but by coercion embedded inside infrastructure. Cannons first, contracts later. This is the foundation of the entire cycle. Military control creates trade dependency. Trade dependency creates currency demand. Currency demand creates privilege. And privilege sets the stage for imbalance. Once this structure is in place, the next stages unfold automatically, driven not by ideology or policy, but by incentives baked into the system itself. Once military dominance secures control over global trade routes, the second stage begins automatically. Massive trade surpluses accumulate at the center of the system. Wealth flows inward, not through conquest, but through asymmetric exchange. The reserve currency nation exports finished goods, services, and control, while importing raw materials and labor at prices it effectively dictates. The imbalance is not accidental. It is structural. Portugal experienced this in the 16th century as spices, silk, and porcelain flowed into Lisbon and were resold across Europe at extraordinary margins. The profits were so large that the Portuguese crown funded the state primarily through trade revenues rather than domestic taxation. The Dutch expanded this model into an industrial scale operation. Amsterdam became the warehouse of the world. Goods from Asia, Africa, and the Americas passed through its ports, generating enormous arbitrage profits at every step. Britain later refined the process by exporting manufactured goods globally while importing raw materials priced on British terms. The United States repeated the same pattern after 1945. With Europe and Asia physically destroyed by war, America stood as the only intact industrial power. It exported machinery, vehicles, steel, and consumer goods to the entire world. The trade surpluses were unprecedented in scale. Dollars flooded foreign central banks faster than they could be absorbed. American gold reserves surged. By the 1950s, Fort Knox held more gold than the rest of the world combined. This phase creates the illusion of permanence. Wealth accumulates visibly. Cities expand. Financial institutions grow. Living standards rise. The system appears stable, even virtuous. But beneath the surface, a transition is already forming. The very success of the reserve currency begins to change incentives inside the issuing nation. As foreign demand for the currency grows, the world no longer needs the nation's goods as much as it needs its money. Production becomes less critical. Consumption becomes easier. The economy slowly shifts away from making things toward buying things. Trade surpluses narrow, then reverse. This transition is subtle at first, almost invisible during periods of prosperity. The third stage marks the formal peak. At some point, what has already become reality is codified. Treaties are written. Institutions are created. The reserve status becomes official. For Portugal, this occurred when international contracts standardized on the real. For the Dutch, when the guilder dominated global bills of exchange. For Britain, when the pound was recognized after the Napoleonic Wars as the global standard. For the United States, this happened in 1944 at Bretton Woods. This moment feels like triumph. It is portrayed as stability. In reality, it is the turning point. Once reserve status is formalized, the internal contradiction becomes unavoidable. Time. 0.5s. The world demands more currency. To supply it, the issuing nation must run deficits. It must send money abroad faster than goods flow back. What begins as privilege quietly transforms into dependency. This is not a policy mistake. It is mathematics. A reserve currency cannot simultaneously supply global liquidity and maintain balanced trade. The system requires deficits to function. And once deficits become permanent, the next stage begins, whether the nation recognizes it or not. The fourth stage begins when deficits stop being temporary and become structural. This is the point where the reserve currency nation transitions fully from producing wealth to consuming it. Past surpluses are no longer generated. Instead, previously accumulated capital is spent down. The system still appears stable because the currency remains in demand, but the underlying engine has reversed. Portugal entered this phase in the mid-16th century. Trade surpluses vanished. The country imported grain, textiles, and manufactured goods from across Europe while paying with gold and silver extracted from overseas territories. The wealth arriving from Brazil masked the reality that Portugal was no longer creating value. The royal court expanded. Military expenditures grew. Palaces and churches were built. Consumption replaced investment. As long as precious metals continued to flow in, the imbalance went unnoticed. The Dutch followed the same trajectory in the 18th century. After decades of dominance, the Netherlands shifted away from production. Why operate factories when accumulated capital could generate passive returns? Dutch wealth moved into finance. Amsterdam became a lending hub rather than a manufacturing center. The trade balance reversed. Imports exceeded exports. The deficit was financed by liquidating earlier gains. The economy did not collapse immediately. It hollowed out slowly. Britain experienced this transition by the early 20th century. Once the world's industrial workshop, it became increasingly dependent on import. Time, 0.5s, food, raw materials, and manufactured goods flowed in. Payment came from returns on overseas investments built during centuries of empire. British factories fell behind American and German competitors. Productivity stagnated. The nation lived on past success while the productive base eroded. The United States entered this stage in 1971. That year marks the permanent reversal of its trade balance. From that point forward, deficits expanded decade after decade. By the early 2000s, the United States was running the largest trade deficits in history, importing far more than it exported across every category of goods. Consumption surged. Production migrated abroad. This system remained viable only because the dollar was still the reserve. Currency. The world accepted dollars in exchange for real goods because it needed them for reserves and trade. The imbalance was financed by exporting currency itself. But this arrangement has limits. Persistent deficits accumulate debt. Eventually, borrowing and taxation are insufficient to sustain spending. At that point, the fifth stage begins. Currency debasement is not a choice made lightly. It is a response to constraint. When obligations exceed productive capacity and borrowing becomes too costly, money creation becomes the path of least resistance. Portugal debased the real by reducing its silver content. Inflation followed. Confidence eroded. Merchants demanded more coins for the same goods. International acceptance declined. The Dutch repeated this pattern as war costs mounted and borrowing strained public finances. The guilder weakened. Britain followed through two world wars. Gold convertibility was abandoned. Repeated devaluations destroyed confidence. Each case followed the same logic. Money printing replaced production. Inflation replaced stability. The United States entered this stage in 2008. Quantitative easing expanded the money supply on a scale without precedent outside wartime. Trillions were created to stabilize the system. A second wave followed during the pandemic. The result was predictable. Purchasing power declined. Inflation surged. The difference this time is scope. The dollar is global. When it weakens, the effects propagate through every economy tied to it. This is the moment where confidence begins to fracture. Not collapse, but crack. And once confidence weakens, the system moves toward its final phases faster than expected. The sixth stage begins quietly. There is no announcement, no formal declaration. Confidence does not disappear overnight. It erodes. Nations do not abandon the reserve currency out of hostility or ideology, but out of calculation. They begin to ask a simple question. If this currency is being diluted, why should we continue to hold so much of it? Portugal experienced this erosion in the late 16th century. Merchants who had accepted the real for decades began demanding payment in Spanish silver instead. Trade contracts were rewritten. Prices adjusted upward to compensate for debasement. By the time Spain annexed Portugal in 1580, the currency had already lost its international role. Political collapse followed market reality, not the other way around. The Dutch saw the same process unfold across the 18th century. Confidence shifted gradually. Other European powers reduced their holdings of guilders. Amsterdam lost its position as the financial centre of Europe. London replaced it. The guilder remained in regional use, but its global function was gone long before the Netherlands formally declined as a great power. Britain's loss of confidence was faster. After the Second World War, war debts, repeated devaluations, and reliance on foreign loans destroyed trust in the pound. The 1949 devaluation wiped out nearly a third of foreign holders' value overnight. Central banks responded rationally. They shifted reserves into dollars. Within 15 years, the pound had lost its reserve status entirely. The United States is now entering this same phase. The shift is visible in data rather than headlines. Central banks have been reducing dollar exposure steadily. The dollar's share of global reserves has declined significantly over the past 2 decades. Gold holdings have risen. Alternative settlement arrangements are being tested. Trade agreements increasingly bypass the dollar. Major exporters have begun accepting payment in other currencies. Strategic rivals have reduced dollar reserves and increased gold accumulation. Emerging markets are negotiating bilateral trade in local currencies. None of this represents a sudden break. It represents positioning. Nations are preparing for a system where the dollar is no longer the unquestioned center. This stage does not require a replacement to be ready. It only requires doubt. Once doubt spreads, diversification accelerates. The system becomes unstable because reserve currency demand is no longer guaranteed. Liquidity fragments. Volatility increases. The structure that once absorbed imbalances begins to transmit shocks instead. Stage 7 is not an event. It is a transition. A replacement emerges not by treaty, but by usage. The world simply stops relying on the old system and adapts to a new one. Sometimes this transition is clean. More often, it is chaotic. The greater the scale of the reserve currency, the more disruptive the shift. The dollar's uniqueness lies in its reach. It is embedded in global debt markets, commodity pricing, time, 0.3s, and financial infrastructure at a scale no previous reserve currency achieved. This means its decline will not be regional. It will be systemic. When confidence breaks fully, the adjustment will affect governments, corporations, and households simultaneously. This is why the pattern matters. Not as prediction, but as structure. Every previous reserve currency followed these stages. None escaped them. The United States is not immune to the logic of deficits, debt, and debasement. The sequence does not care about intentions. It responds only to incentives. The system is now approaching the point where changes accelerate. What has been slow becomes fast. What was once invisible becomes undeniable. This is how reserve currencies end. Not with collapse first, but with confidence leaving quietly and never returning. The final stage completes the cycle. Replacement does not arrive through consensus or coordination. It emerges through necessity. Markets adapt before governments do. Merchants shift first. Capital follows. Only later do institutions acknowledge what has already happened. This is how every reserve currency has been replaced in history. The Portuguese real did not collapse because Spain conquered Portugal. It collapsed because Spanish silver became more reliable. Vast silver mines in the Americas produced standardized coins at a scale no competitor could match. Merchants preferred them. Trade migrated toward them. Within 2 decades, the real had become irrelevant. Political change merely formalized an economic reality. The Dutch guilder yielded to the British pound through the same process. Britain combined industrial production with naval dominance and deep financial markets. London replaced Amsterdam as the global financial center. The transition took decades, but it was irreversible. By the time the pound was formally recognized after the Napoleonic Wars, the shift was already complete. The British pound was replaced by the dollar after the Second World War. Britain was exhausted, indebted, and deindustrializing. The United States held the world's gold and controlled global production. The dollar became the only viable anchor. Devaluations finished what war began. Within a generation, the pound's global role vanished. The question today is not whether the dollar will be replaced, but how. There is no clear successor. China has production and trade surpluses, but lacks capital freedom and global military reach. The euro is widely held, but structurally fragmented. Gold is trusted, but cannot scale to modern transaction volumes. Digital alternatives face political resistance. The likely outcome is not a single replacement, but a fractured system. Multiple currencies may dominate different regions. Settlement may rely more heavily on commodities and gold between blocks. Trade will become more complex, more volatile, and more expensive. Transitions are rarely smooth. They redistribute wealth unevenly. Those holding the declining currency bear the cost. This is why the pattern matters at the human level. When reserve currencies lose value, savings erode, wages lag, pensions weaken. The decline is not sudden at first. It unfolds through purchasing power loss. Since 2020, the dollar has lost a significant share of its value through inflation alone. This is not collapse, it is attrition. History shows that once stage 6 accelerates, stage 7 follows. The timing varies, but the direction does not. Reversing the process would require eliminating deficits, halting debasement, and rebuilding production. These actions demand short-term sacrifice. Democracies rarely choose them. The pattern is not prophecy, it is precedent. 4 currencies across 6 centuries followed this path. Each believed itself exceptional. Each discovered that mathematics is indifferent to belief. The dollar now sits within the same structure, governed by the same constraints. Reserve currencies do not die suddenly. They decline slowly, then rapidly. By the time the shift is visible to everyone, it is already complete. This is not how empires fall. It is how systems reset. What makes this cycle uniquely dangerous today is scale. Every previous reserve currency collapse was contained within a regional system. When the Portuguese real failed, its impact was limited to Iberia and its trade network. When the guilder declined, Northern Europe absorbed the shock. When the pound fell, the damage concentrated within Britain and the Commonwealth. The dollar is different. It is embedded everywhere. Global debt markets are denominated in dollars. Commodities are priced in dollars. Central bank balance sheets are anchored to dollar assets. Trillions in bonds, loans, and derivatives depend on dollar stability. This means a transition away from the dollar will not simply reprice trade. It will reprice balance sheets across the entire global economy simultaneously. Emerging markets that borrowed in dollars will face stress as settlement systems fragment. Corporations issuing dollar debt will confront refinancing risk. Even developed nations holding large dollar reserves will experience valuation losses. This is not a localized currency adjustment. It is a systemic reordering of claims, obligations, and purchasing power. History shows that such transitions are never orderly. They proceed through volatility. Capital moves in advance of policy. Liquidity dries up where confidence fades and concentrates where alternatives appear safer. During these periods, wealth is not destroyed evenly. It is transferred. Those who hold the declining unit bear losses. Those positioned across real assets and productive capacity absorb value. It is important to be precise about what this pattern does and does not imply. It does not predict an immediate collapse. It does not require political failure or military defeat. It does not depend on intent. It follows incentives. Persistent deficits require financing. Financing through money creation erodes purchasing power. Erosion undermines confidence. Diversification accelerates. Replacement follows. Breaking the cycle would require reversing these incentives. Trade deficits would need to shrink. Money creation would need to slow. Productive capacity would need to expand. These changes impose short-term costs for long-term stability. Historically, reserve currency nations have been unwilling or unable to accept that trade-off. Comfort is chosen over correction until options narrow. This is why the later stages feel sudden. They are not. They are the result of decades of accumulated imbalance. The early stages reward the issuer. The later stages punish delay. By the time the costs become undeniable, adjustment becomes painful and compressed. The 7-stage pattern is not theory. It is an observed sequence repeated across centuries. Portugal followed it. The Netherlands followed it. Britain followed it. Each transition differed in detail, but not in structure. The United States now occupies the same position within the same logic. Reserve currencies do not end with panic. They end with adaptation. The world does not wait for permission to move on. It responds to incentives and constraints. When trust erodes, alternatives emerge. When alternatives become usable, the system shifts. This is how reserve currencies end. Slowly, then quickly. Quietly, then conclusively. Not because anyone decides they should, but because the structure no longer supports them. At the end of every reserve currency cycle, there is a moment when the pattern becomes visible to everyone at once. Not because something new happens, but because what has been building for decades can no longer be ignored. The signals converge. Inflation persists. Confidence fragments. Capital moves defensively. What once felt theoretical becomes lived reality. This final transition is rarely marked by a single event. It unfolds through a sequence of shocks. A crisis exposes weakness. Emergency measures stabilize the system temporarily. Those measures deepen the imbalance. Each response trades future stability for present calm. Over time, the currency loses its role not through rejection, but through redundancy. It is still use. Time at 0.3s, but no longer trusted as the foundation. For ordinary people, this stage is experienced as erosion. Savings buy less. Wages lag behind prices. Retirement assumptions break. The damage is cumulative rather than explosive. Those who expect a dramatic collapse often miss the quieter destruction of purchasing power that does far more harm over time. This is how wealth transfers occur without announcement. Every previous reserve currency collapse produced the same outcome. The merchants who adapted early preserved value. Those who trusted permanence absorbed losses. This was true in 16th century Lisbon, 18th century Amsterdam, and post-war Britain. The mechanism has never changed. Only the scale has. The dollar's scale ensures that the consequences will be global. There is no insulated region, no unaffected sector. The transition will reshape trade, finance, and geopolitics simultaneously. It will not resolve into a clean successor quickly. Periods of currency competition and instability will define the adjustment. This is not an anomaly. It is the historical norm. What matters most is understanding that this process is not driven by failure of character or leadership. It is driven by structure. Reserve currency systems reward imbalance until imbalance undermines them. The incentives are clear. The outcomes are consistent. The pattern does not bend to belief. The United States dollar is now far enough along this sequence that reversal would require extraordinary change. History suggests such. Change is unlikely, not because it is impossible, but because it demands choices that are politically and socially costly. Past reserve currency nations faced the same dilemma. None chose differently. This is how reserve currencies end. Not with invasion, not with catastrophe, but with arithmetic. Slow at first, then fast. Ignored until undeniable. And by the time the transition is universally acknowledged, it has already occurred. The pattern has played out 4 times across 6 centuries. 7 stages. 1 outcome. The structure is visible. The timeline is established. What remains uncertain is not whether the cycle completes, but who recognizes it early enough to avoid being trapped inside the final phase.